course, talk a little more about the Fed's decision to leave the benchmark rate unchanged. Christopher Rupkey is chief financial economist for the Bank of Tokyo-Mitsubishi. He joins me here on set. Chris, always good to see you. Thank you so much for coming in. Chris, the Fed move or lack of movement today, not unexpected, but was there anything in the language that surprised you or stood out for you?
Well, it was kind of advertised, I guess, but they did mention the wind down of the liquidity programs. Many of the liquidity programs are going to end as scheduled. Is that where
the market reaction came from?
There was some gossip that they were going to do that ahead of time. But, you know, I think anything that shows that they're inching closer to not just talking about the exit strategy, but to implementing it, makes the market a little bit nervous here.
And we did have something up on screen as we began this half hour. The Fed saying in that statement that household spending appears to be expanding at a moderate rate, though it remains constrained by a weak labor market. There's that jobless figure again.
I know. I thought they would be a little more bullish on the consumer spending, but I guess they still see the constraints out there, as you said, double-digit unemployment rate, and the fact that people can't, well, banks aren't issuing credit cards like they handed out coming out of the last recession. But the consumer spending pattern the last 3 or 4 months looks very, very strong. I mean, you wouldn't even call it moderate. It's definitely on the strong side.
Where's that coming from? Are you surprised by that?
Not really. I think it was held down earlier during the recession, and it naturally wants to bounce back up here. There may be some pent-up demand. We'll see what happens in December, but I think the consumer is saying that the recession's over.
We did also have some more from the Fed statement today. Deterioration in the labor market is, in their words, abating, but they also said businesses still cutting back on fixed investment and, again, quoting, remain reluctant to add to payroll. So there is that specter again of 10% unemployment.
Right, but I think what we should be focusing on is that the jobs picture is changing dramatically here, and by the time they meet next year, the first meeting next year, I think we could very well have positive payroll jobs growth. Even the former Fed Chairman Greenspan is saying that, you know, jobs are going back to positive. There's evidence that the unemployment rate may be very, very close to the peak, if not having already peaked at 10.2%. So all these things are good things in the outlook for 2010.
How long can the Fed stay on hold on interest rates? Is there a danger that the Fed might wait too long to make a move?
For me, I feel inflation doesn't get created overnight. The inflation that went to double digits in the early 80s, that was something that was a decade in the making. There were many policy errors made back then. They're not going to make the same errors right now. I don't think there's any danger that inflation is going to get out of control. But I would say that once the labor market shows that it's stabilized, unemployment rate is on a downward track, and we get a big monthly jump in payroll jobs, 250, 300,000 new jobs created, the Fed's going to start tightening shortly thereafter. So my view is that they could go as early as the June meeting next year and tighten rates.
So do you have any inflation concerns for next year, or is growth going to be strong enough to keep inflation at bay?
Well, I'm not really that worried about inflation. A lot of times a little inflation is necessary, perhaps, to grease the wheels of economic growth, if you will. I'm not overly concerned about it. I know the Fed talks about it, but basically I think they're really focused here not on inflation, but creating jobs. This Fed is very sensitive to the fact that at the peak, more than 9 million people, additional people, lost their jobs in this recession. And the focus is trying to put those people back to work. But that doesn't mean they're going to delay tightening. Don't forget 0.25%, that's an emergency rate. The first moves will not be called tightening. They're just going to normalize the Fed funds rate.
And we should mention the Fed did say inflation will remain subdued for some time. Fed also saying that it's going to continue purchases of agency mortgage-backed securities. Did that come as a surprise to you?
Yeah, a little bit. You know, the focus is what's going to happen. People are very concerned about what happens when they stop what happens when they stop the purchase of mortgage-backed securities. It's coming at some point. Don't forget that mortgages, when the Fed announced the program in November 2008, mortgages, 30-year mortgages were 6%. People are wondering, well, are mortgage rates going to go back up to 6% if they stop buying? So there's a lot of questions out there, and we have plenty of time to see what they're going to do eventually with these purchases.
Fed Chairman Bernanke, he's before the Senate Banking Committee tomorrow. Connecticut Senator Christopher Dodd is chairman of the committee. How's he going to be received?
Well, now that he's Time Man of the Year, I think it would be pretty hard to not reconfirm him.
You don't show the Man of the Year the door, right?
It doesn't seem like it would be a wise move politically, but no, I think he'll get through it. There'll be some criticism, and it'll be tough, but no, certainly he's the best man for the job at this point.
We always hear about his love of history and a student of the Great Depression. His historical context, just in a few seconds, can you tell us how that came into play in his decision making?
Well, one of the things I was shocked about, and I think market participants were shocked about, is how quickly were they going to bring down interest rates during this crisis. And even before the Lehman bankruptcy in September '08, they brought rates down very, very quickly around the era of Bear Stearns being taken over. And I was surprised at how quickly they did that. But, going back in economic history, the best thing the Fed can do at this juncture is to cut rates and cut them dramatically, and that's what they did. So I was impressed by that move. I think it helped shave a few quarters decline off the recession, possibly.
Chris Rupkey of Bank of Tokyo-Mitsubishi joining us today on Fed Day. Chris, thank you so much.